All right, check, check. Going live in a few minutes. Check, check. Check, check. 1 2 1 2. All right, just testing the sound here to make sure everything's good. 1 2 1 2. Just testing the sound here to make sure everything's good. All right, looks like everything is good. Just uploaded the link to Facebook. So we should be good to go there. I apologize for the technical difficulties. Just trying to make sure that everything is as it should be. And I'm still brand new to this, so bear with me here. I'm trying to figure out this live streaming stuff. It's a lot harder than it looks, ladies and gentlemen. All right, we're going to go ahead and get started. So, for any of you who are watching, thanks so much for joining me today. Let's change the scenes here. Welcome back to Lean on Success, where process improvement is self-improvement. My name is Ben. I'm a Lean Six Sigma Master Black Belt. Almost under-certified myself there. I'm a Lean Six Sigma Master Black Belt. And today I wanted to provide you a September financial market update. Now, I did one of these last month. My intent is to do a live stream once a month to cover basically just a summary of all of the things that have been happening in the various financial markets, do some analysis, and then give you my predictions on where I think the economy is heading. So we'll go ahead and pull that up here now. Give me a moment here. All right. All right. So let me just check something right quick and we'll get going here. Just making sure I can hear myself. All right. Well, if I'm muted, I'm muted, but I'm going to roll with it. All right. So this is your September economic update. We're going to start with inflation. What the heck is going on with inflation? So here is the latest report that was released by the Bureau of Labor Statistics, and it shows that inflation went up by 3.2% year over year overall. Now that's up 0.2% from the previous report, which had inflation at 3% flat. So we see that inflation is still being pretty stubborn despite all of the Fed's efforts to lower inflation by increasing the federal funds rate. Now we see that energy is down over 12% year over year, but that's up 4.5 percentage points from last month. We're going to break down and get into all of these in a minute. Your core inflation, which is sometimes known as your sticky CPI, is at 4.7. It's down slightly. Used cars are down 5.5% year over year, and shelter is at almost 8% year over year. So that's kind of the overarching summary for your inflation. Now, in my last update, I talked about how energy costs are really kind of a red herring as it relates to the financial markets and what's happening. We talked about how the Russian invasion in early 2021 is actually what spearheaded this pretty significant jump in energy prices, which, as you can see, have been pretty stable in the 3 years or so leading up to the pandemic. And so what's happening and what you're seeing now is that we're starting to see a stabilization of energy prices after that big run up due to the Russian invasion. We just talked about how your sticky CPI is still, from a CPI standpoint reported by Fred, is at around 5.6%. Now we know that your total CPI is a combination of what we know as your core inflation items, and plus your food and your energy. Now we see here that energy makes up about 7.5% of the overall calculation for core inflation. Right, food makes up 14%, with the remainder being core CPI. What we see is, with the remainder being core CPI. Now, what we see is that core inflation went down by 0.2%, 0.2 percentage points. Food went down by 1.1 percentage points, but energy went up by 4.5 percentage points, resulting in your overall CPI number going up by 0.2 percentage points. Now, why am I pointing that out? Why is that important? It's important for us to understand these relationships. I'm going to switch back here. It's important for us to understand that the way that the government calculates inflation is taking into account all of this year over year declines that we've been seeing in energy. But again, the energy declines are as a result of special cause from the Russian invasion 2 years ago. And so even though the government is reporting the overall CPI being at 3%, that 3% is taking into account the fact that overall energy prices are significantly lower today than they were a year ago, when they were still peaking as a result of the Russian-Ukraine war. Now, what we're going to start to see, and what I'm actually going to be illustrating here, is that this is going to increase back to zero. So right now it's at negative 12.5. Last month it was at negative 17. We're going to see this stabilize to zero or even turn positive in terms of higher energy costs over the next 6 months. Now, I just previously showed you the lower energy year over year is what has been keeping CPI low. So obviously, as energy prices go up, this is going to drive the CPI even higher, not lower than where it is. Now, just like they said on Friday, I'm going to remember that. I need you to keep that in mind and remember that. Okay. All right. So let's take a look at the job market. So now we see here that unemployment unexpectedly jumped upward to 3.8%. This is 0.3% percentage points higher than it was the previous month at 3.5. Now, why is that? Why am I calling that significant? I'm calling that significant because if you remember, I did a video a few months back talking about something called confidence intervals, or the error rate when you're doing surveys. The unemployment numbers are based off of a survey of 20,000 people that respond to a survey. And so anytime that you are reporting a number or formulating a statistic based on a survey, based on a sample of people, you have to be able to report or show what the error rate is within that sample, because you know that because you're sampling a relatively small percentage of people, that as representative as you try to make that sample, you know that there could be a swing up or down in terms of what the entire country is feeling based on this sample of 20,000 people. And so what we know is that the error rate that's calculated based off of that is 0.3, which means that if they report a number of 3.5, the actual number from an unemployment standpoint could really be anywhere from 3.2% to 3.8%, because there's a 0.3 swing either way. So what we're seeing here is, because this number jumped up by 0.3, because it's outside of what the typical error rate would be, we can actually say that potentially this increase in unemployment is actually statistically significant, that there is a significant difference in that number, right? So that's obviously very concerning. Now, when you look at the big picture from an unemployment standpoint, it's still below 4%. And we're on a streak right now where the unemployment has been below 4% for 19 months in a row. This is the longest streak since the sexual revolution in the 70s. I'm going to reference that time period again because we're seeing a lot of commonality between what we're seeing today and what happened in the 70s. Now, that streak was 27 months. I don't think that streak is going to last. I don't think we're going to break that streak. I think that this sub 4% unemployment is about to come to an end for a number of reasons I'm going to get into in just a minute. One of those reasons is we've talked previously about something called the labor shortage. A lot of you may have been hearing about this from a labor shortage standpoint. We don't have enough people to work these jobs, which is why we're seeing unemployment so low, is because these companies can't find enough people. What you're seeing here in this chart is called the participation rate. This is the percentage of working age adults that either have jobs or are looking for jobs. Now, you see that historically, the participation rate has been around 63%, going back to the 3 years leading up to the COVID shutdowns. And then what you see is that there was a dramatic decrease. This was called the Great Resignation. A lot of people got laid off, but then also a lot of people went into early retirement or did career changes. And as you see, as we came out of the shutdowns, now that participation rate has slowly started to creep up, where people are starting to find work again. And now we are pretty much at the level that we were before the shutdown started. So this is an indication that the labor shortage is almost over, and that there are going to be fewer and fewer job openings that are going to be available because these companies are starting to become fully staffed again. All right, so that's good news from an economic standpoint in terms of business. Not so good news when you think about what potentially might be happening with unemployment. All right, let's talk a little bit about the housing market. All right, so first thing we want to look at is mortgage rates. And mortgage rates are still a little bit over 7%. This is the highest that they've been in 20 years, since before the great financial crisis. So housing continues to be extremely expensive from a mortgage rate standpoint. We also see that home prices are still at a record high, despite recent declines in the second half of last year. So this is what we call the hockey stick effect, where We just see this huge surge in prices, and it does not appear that they're going to ever go back to where they were, although we do see some stabilization. Now, the other thing I want to point out is when you look at the trend of where prices started increasing, right? So 2012, the housing market pretty much bottomed out, right, after the great financial crisis. If you follow the trend line, these home prices were going on a fairly steady trend until the shutdowns happen. And then you see that this hockey stick where now prices have jumped way above where their trend line was going. And based off of this, based off of what's called the Case-Shiller Index, housing is approximately 20% overvalued, or the prices of the homes are roughly 20% above their long-term trend from 2012 to the start of COVID, right? So home prices are overinflated and mortgage rates are extremely high, which further exacerbates the affordability. Now, that's why we saw, if you remember, that's why on the inflation report, we saw that shelter was coming in at almost 8% year over year from an inflation standpoint. And shelter makes up a pretty significant chunk of the overall CPI calculation. And part of what I want y'all to understand is that those things come into effect in different ways than what you would expect. Here's what I mean. CPI is 3% year over year. Okay, that doesn't seem that bad. That's kind of in line with what we saw prior to the pandemic. But again, the report is saying that energy prices are down 12% year over year. Well, do we really feel that? Like, when you go to the gas pump, the last time that you went and filled up your gas tank, did you feel like gas was 12% less than it was this time last year? Because I don't. I don't feel like gas is cheaper now than it was last year. I feel like it's more expensive. Yet the report is indicating that energy prices are 12% lower than they were last year. You know, what about your electric bill? Does your electric bill feel like it's 12% lower than it was last year? Mine doesn't. So my point is, there's a lot of things that go into that energy calculation that we don't feel. Here's the other thing. Shelter prices, they're saying that goes up 8%. Now, that's supposed to take into account all of the housing services associated with a home, whether it be rent, whether it be mortgages, homeowners insurance, property taxes, etc. But 8% year over year, that seems pretty light to me. I personally have felt a significantly higher amount of housing costs due to increased insurance prices, due to increased property taxes, due to the overinflated value of these homes. And so while the government is reporting kind of these aggregate numbers, when you go and actually do boots on the ground, the impact that it's having to consumers is very different than what these reports indicate. So it's important for us to know and remember that the way that these indicators are showing in these reports may be very different from what our actual experience is. And that really goes into, it doesn't matter anymore to me whether the government is officially declaring a recession. Which used to be, 2 quarters in a row of negative GDP, and a number of other factors. It doesn't matter to me that unemployment's below 4% if people feel like they can't afford their lifestyle. We're going to get into that here towards the end of the video, because we have an affordability crisis that is not being fully explained by the reports that the government is giving us, which is why I don't trust the government. All right, let's get back into the data. All right, so we talked about how housing prices are overinflated. They're 20% overvalued according to the long-term trend from 2012. Now, for existing homes or used homes, you see that the sales volume is down 20% year over year. Now, that can be misleading based on what types of reporting you're looking at. So a lot of people who are in real estate that have a vested interest in making sure that you buy a home will tell you the market's still hot. Look how high prices are. Inventory is extremely low. You need to go ahead and jump on the house. I recently had a realtor tell me this is the best time to buy a house because there's not as much demand out there. Inventory is very low. the reality is, yes, I've just shown you how prices are still extremely high, but these homes have basically outpriced everyone that potentially is in the market. So the prices are actually driving demand down because people can't afford the houses. And so you see that the actual number of homes being sold is down 20% year over year. All right, let's take a look at the auto market update. All right, so for used cars and trucks, again, we had a similar hockey stick situation happen after COVID. All of the shutdowns, the computer chip supplies dried up. Very difficult to manufacture new cars. So used cars became extremely valuable, and we saw this ridiculous increase. Near the value or the price of used cars nearly doubled from the end of the shutdowns through first of 2022. Now, recently, we are seeing a downtick in those prices, which obviously is good news. 5.6% year over year. And when we look at total vehicle sales, again, we saw that they were hovering around between 17 and 18% prior to the shutdowns. There was a big run up, and then we see that the sales volume started to plummet as inventory became crunched pretty badly and interest rates started to skyrocket and price a lot of people out of the market. Now we are still seeing an overall uptick. The general trend line is still moving upward from summer of 21, but you can see like really over the last 12 months or so, there hasn't really been a lot of improvement over that. It's been pretty flat over the last 12 months. And we're still 15% up year over year, but we're still well below where we were from a sales volume pre-pandemic. Now, we know that vehicle inventory is continuing to increase. The major auto manufacturers are starting to recover or have already fully recovered from the chip shortages. We're about to head into potentially a strike with UAW. I know a lot of you have been seeing the news reports around that. The major union of auto workers for what we call the American Big Three, so Ford, General Motors, and Stellantis. It looks like they're going to be heading towards a strike, which obviously is going to cause a halt in production. We don't know for sure if the strike is going to happen or when it does happen, how long it's going to be. But we know that that is going to put more restrictions around inventory. Now, I don't really think that from a consumer standpoint, we're going to see that much of an impact because the inventory is pretty robust at a lot of these dealerships, but the cars are priced so high that they're way out of the affordability range for most people. So I don't think the strike is going to have that much of an impact on a person's ability to buy a car because they're already too expensive for the most part. I think that you could see prices getting stickier on used cars because there's not going to be as many new cars available and because there's not very many affordable new cars available. I think we are going to see prices in used cars start to kind of stabilize and maybe even go up a little bit during the strike. But the overall affordability crisis we're having in the United States, I think is going to quell sales volumes overall, regardless of what the inventory is. And that's the thing is, I don't want you to be fooled by people who have agendas that are telling you the reason why these prices are so high and why nobody's buying is because there's low inventory. Inventory is a factor when it comes to housing and it comes to the auto markets and other commodity markets. But the reality is, the rent is too damn high. Breakfast, lunch, or dinner. Like it's just people are getting squeezed, right? So let me go back to the data because I really want to get into the affordability crisis here. Let's take a quick peek at the stock markets. A lot of people put, in my opinion, way more weight than they should into this, but I think it's a good indicator of what corporate America's outlook of things are. Now, remember, the stock markets tend to be forward-looking. So the performance that you see currently on the stock markets is an indicator in what the opinion of corporate America is and Wall Street is for the immediate future. Now, in August, we look at the Dow Jones. Dow Jones was down a little bit in August, but up 5% year over year. Now, there's a more compelling story when you look at the S&P 500. Now, the S&P 500 is an index of the 500 largest companies in the United States. Now, what you see here is that in August, the S&P was pretty much flat. Like, prices didn't go up or down. The stock values remained pretty flat through the month of August. However, you see that the S&P has been absolutely on fire, up 18% in 2023. That's one of the biggest single year run-ups that we've ever seen from an S&P standpoint. So the S&P has been absolutely on fire, but this month is cooled off pretty significantly. So I think that's a very telling story in terms of what Wall Street's opinion is of the immediate future in terms of economic health. Okay, I've been teasing it and teasing it. Let's get into this affordability update. Now, I've referenced this earlier in talking about wages versus inflation. And there's a lot of false narratives out there that want to suggest that the affordability to consumers hasn't really been that bad in terms of the affordability impact, because yes, prices have been going way up, but wages have been rising also. And so from this chart, this basically is plotting the percentage wage growth year over year versus inflation year over year, starting January 2020 up to the most recent numbers which we have, which is July of 23. Now, what you're seeing here, the gray line is your wages. So we see that leading up into right at the start of the pandemic, your wage growth year over year was hovering between 3 and 4%, and that was pretty stable pretty much for January of 20 through May of 21. Wage growth remained stable between 3 and 4%, and that's pretty much where it was prior to the pandemic. When you look at inflation prior to the pandemic was hovering between 2% and 3%. So what this essentially means is, if wages was driving between 35 and 40 miles an hour, and inflation was driving, between 20 and 25 miles an hour. So that means that as these months progress and wage growth is outpacing inflation, you're starting to get a little bit of cushion here. Okay, I'm making money at a faster rate than the prices are going up. I feel like I'm, life is getting more affordable for me. But then, as you see, starting around 2021, inflation started to drive a lot faster. It was driving at around 25 miles an hour. Now, summer of 21 is driving 50, and then by the time we get to summer of 22, it's driving at over 80 miles an hour. It picked up speed dramatically in a very short period of time. Now, wages also started driving faster. Wage growth started to go up as well. But as you see, there's this gap here, right? And so part of what I want to talk about is there was a surplus here leading up to the summer or the spring of 21. Then you went into a phase where the prices are increasing faster than wages. And so what happens is that people have to start withdrawing money and going into debt to be able to afford their lifestyle. Now here, what it's indicating is, okay, well, wages are still fairly stable, 6%, 5.5%. Inflation's coming down. But that's a fake surplus based on what I talked about earlier. Okay. Now, remember I told you to remember that about energy prices? We know that CPI is going to start going up higher. Also, the CPI numbers that we saw aren't indicative of what the true affordability is, because we're not feeling a 12% reduction in energy. So that the indication of CPI being down here in the 3% range, that's not what we as consumers are actually feeling. We're feeling a number significantly higher than that and a lot closer to what the wage growth is. The other thing to keep in mind is that they're counting the wage growth of people who have wages. Right? So if you've recently been laid off, or we see there's an uptick in unemployment, wage growth number doesn't take into account the fact that there are fewer people that are earning wages. So for the folks who still have jobs, yeah, you may be growing at a fairly steady rate overall as a group of people. But if there are fewer people with jobs, that means that the overall affordability is worse than what the difference between the wage growth and the CPI growth would indicate, because those people don't have any income at all. So it's important for us to keep in mind that there's context behind this data that we need to fully understand, right? All right, so one of the consequences when you have this gap between inflation and wages is savings rate goes into the toilet. Now we see that leading up to the pandemic, your savings rate was close to 10%, looks like 8 to 10% in the year or so leading up to the pandemic. Now these spikes is when the stimmies hit, because again, savings rate is looking at what the current bank balances are. So when those direct deposits hit, you can see where the savings rate spiked because it was showing an increased percentage of income being saved. But then as inflation started to really take hold and really ravage us, you're seeing that your savings rate now is below 5%, which is honestly the lowest consistent number since the Great Recession back in 2008. So affordability is getting really bad. This is what I was talking about with the people having to withdraw money in the savings. When you look at the total number of liquid deposits, so this counts all money that's sitting in checking accounts, savings accounts, money market accounts. This is like actual cash saved. At the peak of the pandemic, we see that there's about $1 trillion that we've lost since the start of COVID. And in the last 12 months, I'm pointing at the wrong thing. Since the start of COVID, we've lost about $1 trillion in savings. And then the last 12 months, we've actually seen $2 trillion of savings just disappear, right? That's yet another indicator that people are unable to afford their lifestyles, because we're seeing a lot more people drain their savings to keep up with the prices. Here's why that's happening. Now I got this from Zippia. You see here the web address for that if you want to go look at this data yourself. 63% of Americans live paycheck to paycheck. Now, what this means, if you've not heard that term before, is that if they lost their income today, they would not have enough money in their savings to cover bills that to make it to their next paycheck. And so a very large percentage of people don't have even 1 month of expenses saved in an emergency fund. And as this article also indicates, this is not necessarily an income issue. 60% of millennials, that just basically means, people between 25 and 40 who make over $100,000 a year live paycheck to paycheck. Right. And I really want that to sink in, because if you're at an income level that's not impressive by your standards, and you say, oh, well, the quote unquote rich people, they don't have the kind of problems that, somebody like me making $30,000 or $40,000 a year is making. And the reality is, Biggie was right. More money, more problems. Because if you're making a high income, but you still have bad financial habits, you're going to have the same outcomes from a financial health standpoint than someone who doesn't make a high income does. It just gives you more of an opportunity to do dumb things with money, right? So there are so many people that are making $150,000, $200,000, $300,000 a year that don't even have $1,000 saved for emergency funds. So that if something happens, they have to go into debt to do it. And they justify in their mind saying, well, I make a lot of money. I can afford to take out a credit card. I can afford to, spend $1,000 on a car payment every month. And they justify that I can just make enough money to out earn my bad spending habits. And we see that based on this data, that's exactly what's happening at a very high percentage. Now, this is something that really surprised me. It really shocked me. When you look at the credit card delinquency rate, so the percentage of credit card holders that are behind on their credit cards, right, as reported by the credit agencies, we see that right now that rate is at 2.77%. Just let that sink in for a minute. That is at a 10-year high, and it's going higher. Just let that sink in for a second. I mean, think about it. The last year, we've had record low unemployment. Everybody's got jobs. Everybody's working, right? The government's been telling us the economy's great. The GDP has been doing awesome. We've had positive GDP, I think, 6 quarters in a row now. The stock market has been outrageous. I just showed you the S&P's been on fire. These companies are making tons of money and posting record profits. Everything's going great. And yet, with all of those positive signals, delinquency rates on credit cards is spiking. People are starting to run out of money and going delinquent on their credit cards during a time where economically we've had record low unemployment. Everything's been booming, right? That is a sign of things to come, right? That's not good, y'all. It's not good. All right. So that's the credit card delinquency. So a little bit of analysis here. The economy is definitely showing signs of cooling, right? Stock markets have been flat. I showed you that. There's basically been no movement in the stock market, or the S&P was actually negative in the month of August. Unemployment did jump up month over month. That is statistically significant move. That is definitely concerning. Housing sales are plummeting. Mortgage applications are at, I think, a 30-year low right now. Nobody's buying houses because nobody can afford them. CPI, while it is down, is at 3.2% from what it was last summer. Remember, the Fed is targeting 2%. And so if the Fed is taking their actions to try to raise interest rates to get CPI down, it's still not at the target that they've set, right? And that is indicative that the economy, even though it is starting to show signs of cooling down, is still too hot. Again, core inflation, we've talked about this in a previous video. The Fed wants unemployment to be higher than inflation, right? They want inflation rate to be low, and they want employment rate to be higher than it is, right? Because 3.4% is the lowest that unemployment got to, I believe, last summer or earlier this year. And that's essentially the bottom. Like, you really can't get lower than 3%. That is the lowest. Unemployment is the lowest that it's been really in the history of our country, at least going as far back as the Korean War. So we know that low unemployment isn't sustainable. And so what they're comfortable with is for employment to return back to kind of a normal pattern of between 4 and 5%. And they want inflation, particularly core inflation, to be lower than that, because that is indicative that the economy is back in balance. Right now, what we see, though, is core inflation is at 4.7%. Unemployment is at 3.8%. So as long as core inflation is higher than unemployment, that's going to give a green light to the Fed to say we need to raise interest rates again because the economy is too hot. Also, we see that the labor shortage is almost completely vanished. I showed you the graph earlier around the participation rate and how all of these open positions are almost completely filled now at a lot of these companies. And that's indicative that, okay, now everybody has jobs, and we're probably going to see employment start to tick up from that. But that's indicative that the economy is still too hot, right? Again, the Fed's inflation target is 2%. We're going to keep raising rates and keep doing quantitative tightening until we get to that 2% target. But again, we're not going to get there, right? Energy is going higher. We're not going to see CPI get down to 2%. We're not going to see it. And core CPI, certainly not. Now, a couple of things we need to watch out for. The next inflation report comes out in just a few days on September the 13th. And then the next Fed meeting is on September 8th, I believe September 18th. So it'll be very interesting to see what happens with this inflation report. I'm predicting that we're going to see CPI go higher, probably to 3.5%, because again, energy prices are going to start to show an uptick year over year, and that's going to pull inflation higher. We're not going to see a lot of change in shelter costs. Those are going to continue to go up. Food prices are stable right now. There's not any type of special cause that's going to drive down the price of anything from a year over year standpoint. So inflation is going to go higher. Like I said, I'm predicting 3.5% when the report comes out in a few days. And obviously, if CPI is going in the wrong direction from a Fed's goal standpoint, then I would predict at that point that they're going to start to raise interest rates again, even though unemployment is starting to spike upward. And so that puts the Fed in kind of a precarious position, because they don't want to completely crash the economy by raising rates, but they can't get inflation under control either. It's like, well, if the building's on fire and I'm pouring water on it, well, I don't want to completely saturate the entire house. I don't want to get too wet, but at the same time, the fire's not out. So the people trapped inside, they're starting to indicate that they're starting to drown because the water level inside the house is getting high. But it's like, do I let the house continue to burn and therefore drown the people inside? Or do I cut the water off to keep them from drowning, but then let the house crumble underneath them? Right. So the Fed is in a very precarious position, and it'll be interesting to see how they're going to react to all of these markets over the next few weeks. All right. So here are my conclusions. I gave you some of them already. This affordability crisis we're in, it's a powder keg waiting to explode. Right now, people can't afford their life. And so what they do is they borrow more. I call this debt determination. People are determined to maintain their standard of living. And we've shown through the record amounts of debt that we have that we're willing as Americans to do that. We're going to borrow as much as we can in order to maintain our lifestyle. So affordability goes out of control. People borrow more, right? As you borrow more, inflation starts to go up because you're continuing to spend at a ridiculous rate. Prices go up, which means the Fed now is going to raise rates because they're trying to fight inflation, which means that borrowing money is going to become more expensive because interest rates are higher, which then triggers an affordability crisis to get even worse, which means that you borrow more, inflation goes up. And so there's this vicious cycle that we're in the middle of right now, we're seeing, which is why we're not seeing progress on inflation that we want. Now, what we're starting to see is there are some tendrils that's starting to spin off of this powder keg, right? Defaults are going up, right? I just showed you that. Credit card delinquencies are at a 10-year high and trending upward in record low unemployment. Defaults are starting to go up. What's going to happen is, as those defaults rise, profits are going to start to fall and companies are going to start hurting due to these defaults. Profits fall, companies start to go out of business or have to do layoffs in order to circumvent or mitigate the loss of profits. Unemployment is going to go up, and now people can't afford their life. And so now this thing is kind of spiraling under control. So I'm calling this a powder keg because it's a ripe situation for disaster to strike. And I think there's a couple of different things that could set this off. But for me, I think the match is going to be student loan forbearance starting to end this quarter and going into next year. Now, you know, my wife has student loans that are in forbearance, and she's got to start paying it back next year. So this is something that my household is currently experiencing. Now, we're in a fortunate situation where she is prepared and we are prepared to start taking that bill on every month, whatever that payment is, we're in a position where we're going to be able to afford making those payments every month. We're going to have room in our budget to be able to do it. Now, obviously, we're going to have to make some sacrifices, and there's some changes and adjustments that we need to make. But she's got an opportunity to increase her income in such a way that it'll offset the cost of these student loan payments. But understand that there are a lot of people out there that are not in a position to do that. They're not going to be able. They don't have room in their budget for a $300, $400, $500, $600,000 student loan payment. And the government isn't going to continue to extend forbearance indefinitely. The chickens are coming home to roost, and this is going to be, in my opinion, the match is really going to set off the affordability crisis, and we're going to really start to see that spiral start to really spiral out of control. So what I think is going to happen is we're going to continue to see combined households. Well, Ben, what do you mean by that? When you look at the 1970s and 1980s, home prices tripled from 1970 to 1982. Home prices went up 200%. Now, wages started to go up along with it, but the way that Americans were able to manage that is women started entering the workplace in droves. And, I told you I was going to be referencing the sexual revolution earlier in this video. So prior to 1970, you still had a setup of a nuclear family where the husband was the breadwinner, and then you had the wife that would stay home with the children. Well, that paradigm started to shift starting in the 1970s. Now, you can debate about, which one was the chicken and which one was the egg. But the reality is, because women who previously didn't work started to enter the workplace, that increased the overall household income, because now you have two income households that are able to absorb this particular increase and run up in prices and inflation in general. That's how America was able to navigate that ridiculous inflationary period from 1970 to the early 1980s. But I think is our version of that. You're going to continue to see people moving in with their parents and moving in with their children, combined households, people that can't afford rent anymore. Life is getting to them. They lost their job. You got to move back in with mom and dad, right? I think you're going to see a lot of marriages out of necessity. People that say, I can't afford to live by myself anymore. So I'm going to get married or get into long-term relationships because we're in a two-income economy in many places, and I need to be able to afford to live, right? So you're going to start to see a lot of marriages out of necessity. You're also going to see what I call a delayed launch of college graduates, right? When I was a child, the edict from my mother was, look, when you graduate high school, you're either going to military or to college, but you're getting out of my house, right? That was kind of the norm. You graduate high school, and then you're essentially on your own. Now, she wouldn't have kicked me out. But the reality is the mentality that you had was, okay, now that I'm done with high school, I'm not my parents' burden or problem anymore. And now I need to go and create a life for myself. Well, the problem is, for someone that's fresh out of college, 22, 23 years old, they can't afford, a 1-bedroom apartment for $900, $1,000 a month because they don't have the income to do that. And so it's going to be more difficult for those graduates to kind of launch. So what you're going to see is that college age adults and young adults, they're going to stay home and wait longer and longer to leave the nest. So that's what I mean by you're going to have these combined households. Now, there are going to be some consequences to that. First one, marriage rate, I think it is going to go up. We are going to see marriages go up because, again, people are getting married out of necessity because they can't afford to live on their own. I do think we're going to see birth rates continue to go down. We have been seeing plummeting birth rates over the last 30 years or so, as women in particular have started to prioritize careers over motherhood. And I'm not saying that it's a good or bad thing. It's just a fact of life. But our birth rates are dangerously low to the point that women are not having enough children to replace even the population that we have. So we are going to start seeing population decline pretty soon. And I think that our current economic situation is going to continue that because people can't afford to have children right now. I think we're going to see, unfortunately, an increase in domestic violence because, again, people are living together because they have to, not necessarily because they like each other. And I think you are going to see more intimate partner violence occurring. And we know that in many cases, domestic violence is exacerbated by stressful situations. There's nothing more stressful than financially not being able to afford your life. We know that the number one reason for divorce is money problems. That's the thing that most married couples or most couples argue about most. And as money problems get worse and people are together because they financially have to be, unfortunately, I think we are going to see an increase in domestic violence, and we're going to see an increase in fraud. It's very important that we continue to protect ourselves and to watch out for people who are desperate and are trying to find ways to afford their lives that aren't morally upstanding. So we are going to start to see an increase in fraudulent activity across the board, which it's been going up for a long time. I'd really like to end these. I like to end these sessions with some good news, right? I do think that there are some industries that are going to be booming during this period. And so if you're looking for a career change or out of work, I think these are some things that you can consider. The first one is home renovations, right? Now, this is something that kind of hits home for me because my wife is like most wives. She wants a bigger house. That's how most wives are, right? And husbands too. I wouldn't mind a bigger house as well. But again, the way the home prices are and the way interest rates are, I'm not willing to, triple my mortgage payment for a house that's 20% bigger. I'm not willing to do it. And so the conversation in our house has shifted away from how can we afford a bigger house to how can we make the house that we're in look nicer. So I think you are going to see a significant increase in home renovations being done because people can't afford to move. So they're going to be looking to fix their place up. So paint, cabinetry, granite countertops, any type of amenities that you can think of, like concrete slabs for backyards, sheds, expanding driveways, landscaping. That industry, I think, is going to continue to take off in the future because people are going to be more interested in trying to pour money into their own homes. Moving and storage. We're going to continue to see a lot of people having to move around. We know that a lot of companies are calling people back into the office to work. So a lot of people are going to have to move back closer to their offices. We're seeing this a lot already. Even Zoom is calling people back into work into the office 2 days a week. How ironic is that a company like Zoom will be requiring people to work 2 days a week in the office, right? So moving and storage, I think, is going to be red hot and continue to be red hot for an extended period of time, many months, because a lot of people are going to have to move back home out of necessity. Auto repair. This is one that's already blowing up pretty significantly. I work in the auto repair industry, and I can tell you that the demand for auto repair is ridiculous right now because people can't afford to buy new cars. So they're doing repairs on their existing vehicles that they ordinarily wouldn't do because they can't afford another car. So we're continue to see a huge boom in demand for auto repair. So, and it's not, from my understanding, is that's not a very high barrier to entry from an industry standpoint. So if you're looking for work and you're mechanically inclined at all, auto repair is going to continue to be a really hot industry for you to get into. Mental health counseling. Mental health has become so chic in our in our society, and I really want to clarify that by saying mental illness has become almost chic in our society. It's almost now a badge of honor to say that you deal with anxiety or that you have ADHD. People are almost proud to say those things now. And in my opinion, there is a severe shortage of mental health resources that are out there. And we're going to continue to see a very strong demand for mental health counseling as the economy gets worse, because that's obviously going to trigger a lot of depression and anxiety in a lot of people. Debt collection. We already saw delinquency rates are out of control for credit cards. Auto loan rates are on the rise as well. Repossessions are starting to get back to pre-pandemic levels, despite everybody, quote unquote, having a job, according to the jobs report. This is going to be a big business. Now, again, depending upon what kind of collection you're doing, it could potentially be dangerous, but there's going to be no shortage of opportunities to do debt collection and repossessions based on everything that's happening right now. The last one is alcohol and CBD. Bars are, I call them recession proof, because people are not going to be separated from their alcohol. People that drink, they're going to continue to drink, and they drink more when they're depressed or when bad stuff is happening. So anything related to alcohol, bars, restaurants, you're going to continue to see steady progress in that industry. And then CBD is on the rise as the stigma around marijuana starts to shift and change, and people's opinions about it, and seeing the benefits that these CBD products can have in terms of alleviating anxiety, for pain, for insomnia, things of that nature. As people start to see the benefits of these products, that industry is only going to continue to go up in hockey stick. So if you find yourself looking for work or looking for a career change, these are the particular industries that I believe are going to continue to explode. All right, so that's the end of our September update. I really hope that you found this educational and informative. And again, I think it's going to be important for us to really look closely at the latest CPI report that's going to come out on the 13th, and to see how the Fed is going to respond to that. Again, like I told you, I predict that CPI is going to go to 3.5%. And I think the Fed is going to raise rates again another quarter point. Because even though, again, inflation jumped up, it's still below 4%. And as long as unemployment is lower than core inflation, the Fed isn't going to see any reason to stop their quantitative tightening. Now, in a future video, we'll kind of talk a little bit more about banks and the pressure that the banks are starting to feel as a result of all of these defaults, as well as the higher interest rates. They're going to start to get really squeezed. And we're going to talk about that in a future video in terms of what I think Wall Street's response is going to be to that. And we're kind of seeing some of that already in terms of the stocks really cooling down this month or last month. We're already starting to see a lot of these bank stocks are starting to really tank. And a lot of these big corporations are kind of battening down the hatches and preparing themselves for a downturn, right? And again, we're going to continue to see increased layoffs. I predicted last month that the holiday season from a retail standpoint is going to be pretty low. Businesses are going to struggle a lot during this Christmas season, in my opinion, because, unemployment is on the rise. Inflation is higher than ever. People are in higher debt than they ever have. They're defaulting. There's no stimulus coming. And even if the Fed pivots and cuts rates, which nobody expects, there's not going to be any immediate benefit to the consumer, because inflation is still, in my opinion, not controlled, right? The fire is still burning, and the Fed has not been able to put it out despite their best effort, right? And a lot of that really has to do, again, with debt determination and how people are just determined to maintain their standard of living regardless of, what the prices are. So for me, the most important thing is to continue to do all of the things that are financially smart in general, right? You should have an emergency fund saved. You should be managing your debt well. You should never be in any kind of credit card debt. That's just the devil. We've talked about that many times. And if you are not being financially responsible, there's never a better time than today to really start to make different decisions about how you are managing your money, to make sure that if and when emergencies happen, that you've got the funds in the bank to be able to weather those storms. So again, really hope you enjoyed this today. Leave me a comment. Let me know what you think about everything. Thank you so much.